mywealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled Vexed by the VIX. Okay, the market shows little fear. Is it time to be worried? The CBOE Volatility Index, otherwise known as the VIX, is commonly referred to as the fear index, as it measures the market's expectation of volatility using S&P 500 index options. Generally speaking, the value of the VIX at any given moment in time is the amount that the market thinks the S&P 500 can rise or fall over the next 30 days. Okay, while the VIX can measure uncertainty over market gains or losses, it is typically associated with bear markets, as investor psychology tends to worsen when the market is falling as opposed to rising. Okay, to see proof of this, look no further back than October of 2008, when the stock markets were collapsing during the height of the credit crisis. It was at this point that the VIX reached its highest levels by far, and justifiably so. Since that time, the equity markets have rebounded from their March lows, and the VIX has returned to Earth from its stratospheric levels. Okay, but has it come back too far? Is the VIX telling us that we've now returned to reasonable levels of uncertainty, and that the markets have stabilized? Well, there are two major reasons why the equity markets should be more fearful than they are right now. Let's have a look.
As always, be sure to check out the written blog at www.mywealth.com/blog. Alright, so what we're looking at here is we're looking at a chart of the VIX, the Volatility Index, versus the S&P 500 Index. Alright, and as you can see, for there's a period of time, this is a 5-year chart we're looking at, but, back in 2005 through 2007, you could see that the S&P's had a nice steady climb. Okay, and then the VIX kind of popped around, down at these levels here. These levels are actually in the 10 to 20 range. These performance charts, they just show the percent performance that these things do, not the actual levels. But as you can see here, as the market was still trucking along, and then all of a sudden the VIX started to rise, and we're looking at about July 2007, and it kind of moved around here. Okay, and the markets yet continued to climb until right about when we got into 2008. Okay, now as you can see, the VIX kept moving around, and boom, market started to decline. We get to last October, okay, which is when we had the major market sell-off due to the credit crisis, and wham, okay, the VIX just spiked. It went flying up to its high, which was, I think, was October 25th. The high was up in the mid 80s. All right, so that's quite a move. Okay, basically it was 4 times higher than it was the previous year, so that's quite a bit. Now, if you look at where it is today, okay, the VIX is right around where those levels were, okay, even going back to the beginning of 2007. So there's a little bit of fear there, okay, but as you can see, the markets have been coming back up since the March lows, so we'll have to see how that plays out. But, I'd like to see the VIX get a little bit lower, which would mean that we had more people thinking that the markets were going to be stable. But at this point, I'm just wondering if where this level is right now, if we're justified in being this low. So let's take a look at some of the factors that can affect this market and really derail the gains. All right, the first thing is the U.S. strong dollar policy is a joke. Okay, this is leading other countries to call for a new world reserve currency. All right, now this is nothing new. We've talked about it here, but you hear about China and Russia and all these folks saying, oh, we need a new world reserve currency. The U.S. is devaluing the dollar and it's hurting us. And in a lot of ways, it's true. Through our record low interest rates, quantitative easing programs, we would probably have negative interest rates right now if it were possible. All right, but it's not, so we're just at zero. Okay, and ballooning deficits as well. These are all threats to market stability. So, when you get people talking about the new world reserve currency, this is kind of what they're talking about. All right, but since the currency in the U.S. dollar has been falling, okay, this has actually been good for the stock market. Stock market has been up since the March lows, and we've had a nice little run here. We're moving back. We're just about today. We're right around Dow 10,000. So that's a nice psychological level to be back to. All right, now let's take a look at a chart we're going to look at the U.S. dollar versus the S&P 500 here. What we're looking at is the UUP in blue, which is the U.S. dollar bullish ETF, and we're looking at the spider. This is the SPY, the S&P 500 ETF. And as you can see, back here from about April, as the spider started going up in March, okay, you see the dollar starting to slowly go down. All right, so that's the correlation. This is no surprise to anybody. That's been the trade. Short U.S. dollar, buy everything else. Dollar goes up, and you want to sell other things. So, this correlation's been around for a while, and it's just going to be interesting to see whether or not that can hold up, because to think that equity markets are going to keep going higher as the dollar keeps going lower, well, that may be a little bit premature. Okay, because if foreign holders of U.S. dollars start dumping them, okay, then commodities and physical goods are going to benefit. Okay, not U.S. stocks. And if you think about it this way, if we get into this hyperinflationary environment, okay, where there's too many dollars out there and chasing goods, well, what do you want to buy? Do you want to buy stocks, or would you rather own gold? Or would you rather own oil? Okay, gold and oil, you know what? People are going to want those abroad, so they're going to have value. Stocks, well, it's still denominated in U.S. dollars. So, if you have to, if we get hyperinflation and now shares cost, say, $2,000 and you get to sell for $2,500, well, you made 25%, but the dollar's still worthless. And that's basically, the point I'm trying to make here is that if we do see hyperinflation, then stocks aren't going to be the place that you want to put your money. You want to have it in physical goods, real estate, things that other people are going to want and be able to pay for with other currencies and/or precious metals. All right, now that's that last scenario is a little bit far-fetched, okay? But in order to avoid that, the Fed's going to need to raise interest rates to avoid hyperinflation, right? And they may need to do so rapidly. Right, if you think about it this way, right now, there's a lot of people calling for higher interest rates here in the U.S., most notably, foreign holders of dollars, namely China, Russia, all these other folks who have a lot of reserves, Japan as well, although they're not as loud as China is, say, okay? But if it comes down to it, if we do start to see inflation, all right, and people start to sell dollars, all right, the Fed may have to move to raise rates. And if that dam breaks, so to speak, they may need to move rates rapidly, okay? So we're not talking about, let's move it up 25 basis points a quarter and see how the market's doing. I mean, they may need to take some serious steps. And if they do that, that's going to have a major negative impact for stocks as well, because now you're going to have people selling stocks. They're going to want to get into bonds and other things that are going to give them higher yield. So rising interest rates, as we said, it could derail the stock market gains, and it could lead to a W market recovery. Now, you've been hearing about all these different letters. V-shaped, U-shaped, L-shaped. Well, nobody wants the L-shape, but we may get the W, which is the double dip, double bottom recession. All right. So if that happens, this could be a result of rising interest rates, and that's what Bernanke's been trying to avoid. But it's going to be questionable about how much longer he can avoid it. So. How this all plays out, we're going to have to wait and see. So don't wait. Get educated. Get in a course. Come to www.mywealth.com and learn about how the dollar correlates to equity markets and what you can do to protect your investments.
Either way you slice it, these are two doomsday scenarios which could have major negative implications for the stock market. Investors and traders alike will have short memories this time and rush for the door at the first sign of panic, which in turn will help move the markets lower. Okay, now this brings me back to the current level of the VIX, which is sitting somewhere around 22.5 at the time of this writing. Okay, if the VIX was at its highs back in October of 89.53, okay, then shouldn't it be a little bit higher, at least, considering all the negative factors facing this market? Well, yep, I happen to think so too. So anyway, to learn more about how correlations between the U.S. dollar and the equity markets work, be sure to check out our currency trading courses. So I'm Mike Conlon. Thanks for being with me, and I hope to see you in those courses.